Here, opening the doors, and here we go. Getting everybody loaded in this morning, which is good. Everybody give them time to get their coffee. Jimmy, you got your coffee going?
Yep.
There you go. Actually, I'm going to use my special coffee cup that we were just talking about. And I'm sending you one of these, Jim, so you can not have the cup you're using.
Oh, yeah. No, I love that cup. That's awesome.
There you go. So hold on. There's the cup. All right, so we've got to get the chat going, and good deal. Tony's welcomed everybody into the chat. That's perfect. Excuse me. About 9 o'clock, we're going to give everybody a minute or two to get into the program this morning. I am Richard Kimball with CrossCountry Mortgage, and we're happy. This is part of it's really part of our wealth series where every month we try to bring somebody or something of value. We've done classes on budgeting. We've done classes on credit. We've done classes on student loan forgiveness. We've done classes on protesting your property taxes. And this is one of my favorites because it's about credit. So this one, and we have one of our favorite people in the world, Jim Droske, with us from Illinois Credit Services. Jim has been an asset to our customers and our team we've been at this a dozen years, Jimmy, I think.
A little bit over, possibly, yeah.
Yeah, about a dozen years that Jim has been my only go-to guy for credit. And when you guys get through this presentation today, you'll know why. Ultimately, and it really says a lot about Jim, because generally for vendors, I like to keep two. I just always like to keep two vendors, two title companies, two appraisal companies, two those types of things that we use. I don't do that in the credit space, and I don't do that because I've got the best guy, in my opinion. So I don't think I can introduce you any better than that, Jimmy.
No, that was pretty good.
There you go. So what we're going to do is for everybody that's here, we're going to be interacting with you. I see Manish is in here. We'll be interacting through the chat, and essentially any questions that you guys have through the chat. Unlike a lot of the presentations where I do all the talking, we're going to have Jim do all the talking, and I'm going to kind of moderate, get your questions in when it's appropriate. We've done the presentation. So if you do ask a question and I wait a couple minutes, it's just because I want Jim to be able to finish his point or clear through the slide. We've got a lot of great stuff here. Ultimately, credit is so vitally important, not only for getting a mortgage, but you'd be surprised all the other areas that it impacts. For example, the cost of your homeowner's insurance can many times be based on your credit score. So Jim's going to get into that. I'm not going to steal all of his thunder. Jim, I'm going to turn things over to you. Welcome, everybody, and we're going to get started.
Thanks, Rich. I really appreciate it. Okay, first off, I'm going to share my screen. And let's see here. Can you guys, let's see here. View slideshow. Okay, here we go. Can you guys see that?
Nope.
No.
It only worked when we did the practice sessions.
Okay, hold on. Sorry about that. Let's see.
That's okay.
Share screen. Oh, here we go.
All right, now we're good. Except you got to get us to the main screen.
There we go. Okay, we good?
Yep, now we're good. We look awesome now.
Okay, so what we're going to talk about today is a lot of things, all credit related, of course, and with the primary focus on mortgages and the impact to that and how to improve credit and so many different things that just really are misunderstood because they don't teach anything about credit to consumers. So, and there is some big news that we're going to talk about a little later, that possibly it's the biggest change in credit reporting that I've seen in 15 years. So it's really going to be, it's a game changer for a lot of people. But as like Rich said, as we go through this, ask questions, because chances are if you have that question, somebody else does too. So let's hammer it right then and there.
Yeah, and Jimmy and I talked about this big reveal that he'll have later in the presentation. It was actually mentioned last night in the news, so we're gonna cover it here. I'm really excited. We got a chance to cover it in our pre-presentation meeting this morning, so should be fun. So stick around. There's some good stuff coming.
Awesome. Okay, so real quick, I know Rich gave a nice introduction for me, but I do like people to understand a little bit of my background, only because there's a lot of so-called credit experts. Everybody's an expert on Google, and people they claim to have a lot more knowledge than they actually do. But I've actually been in credit related industries for 32 years. I've owned a mortgage company. I was in auto lending. I did the lending world for 20 years. And then I started Illinois Credit Services really to help people understand how credit works and fill that gap of being a transparent company based on education. So I've taught classes on credit and credit scoring at the College of DuPage for the last 8 years. I work on federal court cases as a credit expert witness. Law firms will hire me to explain how credit and credit scoring works to judges and juries. So that's a really heavily vetted process. So it's, I don't really have to say I'm an expert. The federal court system calls me one, which is probably a better thing. So, okay. So what we're going to cover today is we're going to cover a lot of stuff, why credit's important, how it works, some changes, the big changes that are happening, and ways that you can improve your credit too. So we're going to be after I did one of my presentations, somebody told me afterwards, they said, a lot of great information, but I felt like I was drinking from a fire hose because there's a lot of good stuff in here. So hang on tight. So what I like to kind of define first, like, why don't we know more about how credit works? And so let's talk about the three bureaus, right? I like to kind of refer to them like General Motors, Ford, and Chrysler. People aren't really familiar with Equifax, Experian, and TransUnion, other than that's the company that creates a credit report. But this list right here, this is a list from the Consumer Financial Protection Bureau. It's just a snapshot of 5 years of the top most complained about companies. We're talking about everybody. We're talking about Comcast, Sprint, the big banks, everybody. Every single year, the three credit bureaus are on the top 3 spots all the time. So they have a lot of complaints because at the end of the day, these companies we are not their customers. We're the product that they sell. That's really important to understand. They don't have a customer service line that's going to help you figure things out. They're out just to sell our credit reports and make money. So we all kind of have an idea that when people's credit scores are low, banks tend to charge more interest. They tend to make more money, right? It's just the way it works. But why would a credit bureau really care about someone having low credit scores? That's maybe not so obvious, but I think it's important that you understand why they don't really care that we all have 750 credit score. So let's look at 2 scenarios. One person has a 750 score. The other person has a 550 score. They both want to buy 3 staples in life or get 3 things: an auto loan, a mortgage, and get a credit card. If you are a 750 credit score, more than likely you have to have 3 inquiries, right? 1 for each. You're probably going to be approved. There might be a couple more than that, but typically it's 3 inquiries for those 3 purchases. That's it. If you're a 550 credit score, you do not. Rich, can you get a loan with a 550 credit score typically?
It's really tough. It's not impossible, but it's really tough.
Right. So more than likely, you're going to have more. Same thing with car loans. When people hear about, hey, that car dealership ruined my credit because they have one button and they shotgun it everywhere, and credit cards too. So here's the thing. On average, if you're a 550 credit score, you're going to have 6 to 8 inquiries for an auto loan. A lot of times that's more. Mortgages, 2 to 3, and credit cards, 2 to 3 as well. So the same 3 purchases, if you're a 750 score, you have 3 inquiries. And if you're a 550 score, you have 10 to 14. It's 4 to 5 times more inquiries. Now think about this. What do the credit bureaus sell? They sell credit reports. They're going to sell 4 to 5 times more reports if people have lower credit scores than higher credit scores. So why would they want to sell, less versus more? So let's talk about some of the expenses. Now, some of this is going to be a little bit of a no-brainer, but I like to put the math to it so that you understand exactly the difference between having good credit and questionable credit or not as good. If you get an auto loan, and 25 grand, honestly, is probably a low auto loan right now. If you get a loan at 5.9 for 72 months, which is the average term nowadays, your total interest is $4,700. If you get the same loan and you have questionable credit, you might walk out paying $597 a month versus $413, but you're going to pay $18,000 more in interest, and you're going to be driving the same exact car as the other person down the road. So it's a staggering dollar amount. Same thing for mortgages, right? And so it's on a bigger level, longer term. If you get a 4.5 rate versus 5.5, your total interest is about $55,000 more if you're on a $250,000 loan, right? So we all know it's important. I just like to put some math to these things. Here's one that people don't really know about too much. And Rich mentioned homeowners insurance, which is absolutely true as well. But this is the one I like to bring up. This is auto loan insurance in Illinois specifically. And I use this when I testified in an arbitration hearing to use this as an example for the judge. If you have poor credit and a good driving record, that's the big bubble in the middle. Your average in Illinois for auto insurance, and this could be multiple cars in a household, is $2,500. $2,500 if you have poor credit. Look at the one on the right. If you have excellent credit and a DUI, then it's only $674 more. It's basically $900 cheaper to have excellent credit and a DUI than poor credit with good driving record. It's that important for everything that you're doing. Some things that you just aren't even paying attention to. There's a lot of numbers on here. Just look at the highlights. When you add up these, 30% of the population has a credit score of 649 or less. That's a boatload of people. It's almost 3 million people just in Chicago that have credit scores that are being impacted to some degree with the numbers that we just talked about. So it's chances are, if it's not you, it's probably somebody that you know as well. So it's good to try to curb the ship or right the ship, I should say. So totals, this is all the totals of those numbers. And then I want to start getting into the credit. If you are in that situation with some credit issues, your totals every 6 years is almost $34,000 for the same purchases, just what things are costing you more. And it's $465 a month. It's a car loan, basically. So
and I'll touch on one other thing, Jim, too, that people don't realize is that the PMI or private mortgage insurance industry also began to start charging more for lower scores after the housing bubble. And it could be very like, hey, I'm going to get a conventional loan. This is great. You could literally pay mortgage insurance that's more expensive than an FHA because you have lower credit scores. And I mean, the difference I've seen is could be $100 or more. It's pretty dramatic.
Yep.
That's on the PMI or private mortgage insurance side.
Right. And that's just one aspect, right? I mean, it's so hopefully as we go through this, right, as we go through this, you'll understand the purpose is to understand what does the scores really mean and how to correct them. So what's my real score? So you go to a car dealership, they might tell you your score is a 512. You get your credit card statement in the mail, it says 618. Rich pulls your credit. He tells you it's a 561. Experian pulls, you go to Experian.com, and everybody, I love this part because everybody says, I'm going to get it right from Experian, right from the bureaus. That's the right one. And they say 627. And then you go to Credit Karma at 644. So the question is, which of these scores is real? Which one's right? And the real answer is that all of them are right. And because a credit score is nothing more than an opinion about your credit report. Opinions are not wrong. If I have an opinion and you have an opinion, neither one's right or wrong. The way I like to explain it is the better question is which opinion matters. And that just depends on what you're trying to buy. If you're trying to get a mortgage right now, and the only scores that really matter are a certain score that Rich is going to pull, and we're going to talk about those scores. But none of them are necessarily wrong. They're just different. The problem is they don't tell you this because you're never in all 5 of these spots at the same time. A lot of people think, well, my car dealership gets a different credit report than the mortgage company gets. That's not, the reports are exactly the same. Experian, TransUnion, and Equifax deliver the same exact information that you see on Credit Karma that Rich pulls when he pulls his mortgage report. Now, I'm not a fan of Credit Karma. There's reasons for that, but because the report is not laid out very well, but the information itself is the same. It's just the scores are different. So I want to show you exactly how different. This is a live, real world example. It doesn't get more real than this. This is my daughter's credit report. It was back when she was 19 and I helped her get a car loan. And what car dealerships typically do is they will pull one report. This is just her TransUnion report, and they run it through two different models. And we probably all have heard of Fico scores, right? There are right now 40 different FICO models that are commercially being used. So what happens when Rich pulls the credit report, his report information is filtered through a scoring system. And that scoring system, they'll say, hey, here's your FICO score, but it's a very specific FICO score that's called a mortgage FICO score. It is a scoring model that was developed and used only in mortgage lending. No one else uses it anywhere else. And when you go to a car dealership, they also pull your credit report and run it through a FICO score. And the problem is they just say, here's your FICO score. But the auto dealers use a very specific score called an automobile FICO score. Same thing for credit cards. They have a bank card score. There's insurance scores. There's 40 different FICO scores. But beyond that, there's hundreds of other scores too that create more and more layers of confusion. So it's just very, very important that when you see your score, don't take it so literal, because when you're trying to get a mortgage, you need to know what Rich's scores are. Okay, everything else can be a little misleading. All of them are kind of guides at what your scores are, right? So chances of having one score be an 850 and another score be a 500 isn't really going to happen. But this is the example I wanted to point out. This is my daughter's credit report. The car dealership, they have multiple lenders. They have 20 different lenders that use different types of scoring models, and they run one credit report through multiple models, and then they try to pick and choose where they can finance a purchase. So one of her scores was an 844 through a FICO FICO score 4, and the FICO score 8 was a 668. It's 176 points difference. So if somebody says, what's your score? And you say a 668 or you say an 844, those are two different borrowers typically, but it's really not two different borrowers. It's two different scoring models. So it's very important to know what you're looking at. Okay, so this is one of the biggest takeaways that you really need to wrap your head around. What does a score really mean? People tend to think that a credit score is a grade of what you've done in the past, right? Because you have your credit report, you have all the information, and then you have a credit score on there. And it kind of seems that way, right? Grade of what you've done in the past. And that is actually not true. A credit score is not a grade of what you've done in the past. A credit score is a prediction of what you're going to do in the future. Okay, so FICO scores, and we're going to talk mostly about FICO scores because that's the one that 90% of the lenders use, right? So FICO scores were created in 1989. They were designed to help lenders figure out if they want to lend you money, right? And they're still the relevant scoring model now, and these scoring models have evolved over time. And lenders don't really come out directly and say this, but lenders typically care about one thing. If I lend you money, are you going to pay me, right? And so that's the future. That's not the past. So when a scoring model is designed, it's designed to analyze information in your credit report and look for clues of anything good or anything bad that's in that credit report without knowing your income. Rich is going to ask you your income because that's part of the application. Your income, your assets, how much money you have in the bank, if you won the lotto last week, anything, none of that information is part of a credit report. It's part of your application, and that's different. Okay, so they only know scoring models. It's a computer. They grade what they see, good or bad information. They're looking at all the information in the credit report, and they're trying to predict likelihood of you going late in the next 24 months on one of your obligations, because that's what the scoring models are trying to predict, help lenders figure out if they want to lend money. So the higher the odds, the less odds of a default, obviously, right? Lower scores mean, hey, it's more likely that you're going to go late. And there's reasons why things like recency and severity all come into play. So we're going to cover these components right now we're going to touch on each one. We can dive deep into each one of these things. And if there are questions, I think we're going to type them in the chat box. So ask away. But I want to cover each one of these components because they all apply to all 5 of the FICO models. Okay.
Yeah, I would say we'll take a second, Jim, just to see if anybody has any questions.
Yeah,
So, I
sure.
mean, I think certainly we've covered the fact that every industry has a different scoring model. So, yeah, I always my comment to people is like, look, you could apply for a credit card, a car, and a mortgage all in the same day within an hour and get 3 different credit scores. So,
Oh yeah.
and ultimately then you add on Credit Karma like you had in your slide, and they're just different. So, that's a big deal. Knowing what your mortgage company is looking for is also really, really important. And so why we always encourage people thinking about buying a house, even if it's in the late summer or fall, get with us now. Let's find out if anything's going on with your credit. Let's find out if we can make some recommendations. Let's find out if you need Jim's help. So the sooner we can do that, the better. So perfect. So if we don't have any other questions, here we go. Tony, Oh, okay. So if I wanted to check my individual scores, is there a way to do that? Like so the question that came in is could a consumer get a mortgage score or a car score on their own without going to our auto dealership or mortgage company?
Yes, for sure. And there's more sources for this that are developing, but you can get, and by the way, you don't, when you're shopping, when you pull the credit, you don't want multiple places continuing to pull the credit reports, right? So, but if you want to see your scores, your industry scores, all 4 of these 40 FICO scores, you can go to myfico.com and get those scores. Okay. It's myfico.com. It's not the cheapest monitoring service around because FICO knows they have the goods, right? And but I'll be honest, the report information, the layout of the report, it's very cumbersome. It's the value of going there is to see the scores. Like what I do, I'll go to my FICO just to see the scores, and then I'll subscribe to a different monitoring service that I use just to see the layout of the report, because the reports are the same. It's just one's easier to read than the other, but one has the scores. So you get about 25 of the 40 FICO scores from myfico.com, but you will see the auto loan scores, the mortgage scores, all the relevant ones.
And Jim, let's talk about this because I know we've covered this in another presentation, but the FICO, Experian, TransUnion, and Equifax, those are actually 4 different companies. Can you explain to everybody what FICO is?
Yeah, sure. So FICO stands for Fair Isaac Corporation. It's a statistics company. It's not, they're not a credit company. They're math people. And so what happened, the long old story is the credit bureau started selling credit reports, gathering data and selling it to lenders, but it never had a credit score on there until 1989. The credit bureau said, hey, you know what? These lenders appreciate the information, but they don't know what to do with it. They're trying to, they want to, we need to help simplify this. So they hired this math company that is has engineers that said, okay, what do you want us to do with this? And they said, come up with a scoring system that figures out if somebody's going to go late or not. So they developed the first FICO scores. And so FICO became a $1 billion corporation because FICO scores became so important and relevant, but they kind of rode the coattails of the credit bureau. So the bureaus create the data that's in the report. FICO scores it, basically.
Yeah, that's a perfect explanation. I wanted to get to Frank, and I also wanted to let Frank know that we're going to give him one of these cups because he had our first question. So we're going to promote some interaction. So we've got these Team Kimball cups with these fun phrases on them. But Frank had asked, can you get a different score through different mortgage companies?
You, I'm sure, can comment on that as well, but here's the thing. No, the answer is the short answer is no. This is not by design by lenders. It's the law, actually. The Fannie Mae and Freddie Mac, right? The 2 GSEs, the government sponsored entities, they basically control the mortgage industry. And so it's a law that's that every mortgage that's underwritten in the country must use the same exact 3 scoring models. So the answer is no, it's all the same. Now, something could be different if something changes from one day to the next, but they're all the same scoring model. So don't think that if you don't like your score here, you go over here and it's going to be better, because it's, it's not.
Yeah, great question, Frank. We have another question that came in from Mike. We're also going to award Mike one of these great cups. But he had said, is it true that a consumer has a time window for shopping for mortgage rates and it will only show as one credit pull? If so, what's that window? So what he's referring to, Jim, is inquiries. So
Yeah.
we've got that first inquiry with ABC Bank, let's say. How long could he go?
Yep. So
You explain.
yeah, for sure. So, and this is something that we're going to cover later, but let's hit it right now. So, it's called deduplication logic or inquiry compression logic. It's something that FICO built in for three purchases: for mortgages, student loans, and auto loans. Basically, the idea is the consumer has the right to go shopping for a mortgage, shopping for a car loan, and chances are they're only getting one, right? You're not out trying to get three houses. You're trying to get one, but you want to shop for an interest rate. Same thing for car loans. So there's a window of time that I tell people typically it's 30 to 45 days. But here's the thing, and what I mean when I say um, the window of time of all the inquiries for that same purchase within that window are compressed for scoring to count as only one. They will show up on your credit report, but you can actually have 100 auto loan inquiries on your credit report. If they are all within this window, it looks bad. You're going to have a boatload of them on there, but the scoring models are actually only going to score it as one. Same thing for mortgages. It doesn't matter if you have one or if you have 20. Now, there's other reasons you don't want to have that many inquiries, but it's not really for scoring purposes. Now, the window of time that you're asking about, the answer is it depends, which is a very common answer in the world of credit because there's all these different models. It depends on which model it is. Some of the models are actually 14-day windows. Some of them are 30. There's another model that's 45. So I typically tell people 30 to 45 days for mortgages is what you want to look at, but you don't want to abuse that too much. What I would do personally is if you're looking to see if something has changed, you have Rich pull your credit and then you go to my FICO. And then because if you see the change on my FICO on your credit report on your scores, then you know what the lender's going to pull the next time because it is the same scoring models.
So Jim, we got another question. We're going to be getting
Yep.
rid of a lot of mugs, which is good. I like it. So Erica asks, so as a follow-up question, is there a way for a marginalized or low-income consumer who wants to build their credit up to access their FICO score on a platform that's fiscally accessible for long term? The monthly fee on my FICO could be cost prohibited for a low income consumer. So what are you recommending as an alternative to my FICO?
Well, I mean, there's no legal obligation for any of these companies to provide you credit scores, right? They just don't. So, good or bad, I mean, I think they should, right? Especially when someone, needs the help and they should know what those scores are. But that's part of the mystery. Like that's part of the lending process, the credit scoring models and FICO and they just don't, we're not their customers. They're concerned with other relationships, not necessarily relationships with consumers directly. What I would do is I would just pay attention to your scores. And there's a lot of places you can get, you want to watch the content really more than the scores. The scores are different, but if you have healthy content in your report, you have healthy scores. You tend to.
But
So
hey, Jim, and just to follow up on Erica, she's talking about a client who wants to build their credit. So I think they want to see the scores go up as they're building it. And is there a place you would send somebody? I don't even know what my FICO charges, but is there a place you could send somebody where they could track their credit at a cheaper rate than my FICO?
Yeah, I mean, you could. Yeah, okay. I maybe misunderstood that a little bit. You could go to Credit Karma if you wanted to. I'm not a big fan of that, but if you truly wanted to do it for free, you're going to see. Don't think that Credit Karma is totally free because they're designed to make money through affiliate relationships. They're going to have you signing up for everything under the sun because that's how they make their money. So I use a website called seemy.credit, SEEMY.credit. That's it's not .com, it ends in .credit, but that's the one that I use to monitor my credit. It's less expensive than my FICO. But any source, what you want to do when you're building credit, just be consistent with looking at the same scoring model. That's important, because what you don't want to do is, as you're building credit, look at Credit Karma, then go over here and look at your scores here and over here, because if it's a different model, you're getting a different perspective. You have to make sure you're looking at apples to apples, oranges to oranges, and keep looking at, because they all scores tend to rise in the same manner, or fall for that matter. So I would take anyone that you can get that's less expensive and cheaper. Again, Credit Karma could be used as well.
Okay, thanks, Jim. That's Erica. Thanks you too. Okay, so Atalia asks, and I'm not sure that I think this is probably a question for both of us, but when should consumer consider bankruptcy? And I guess I'll address that, because I'm not sure, I'm not sure that's in either one of our lanes particularly, but is there a score minimum or maximum? If not, how should consumers resolve delinquent accounts to rebuild credit in order to improve their credit scores? So, yeah, that's a tough one relative. I guess part of the question is, I'll go to you first, Jim. Part of the question is like, hey, the consumer's credit score is X. Is it just time to throw in the towel, file the bankruptcy, and get the restart? You answer that part, and then I'll see what I can do to address the second part of it.
We run into this a lot, actually, because people are having issues or problems. And here's my answer, without giving bankruptcy advice, is it's not really a score. It's not predicated on what your score is, how low it is or not. It's a matter of credit is credit, debt is debt. If you cannot afford your debt, that's a different problem. That's when you have to figure out how you're going to get back on track. I'd be very careful. Don't fall prey to a lot of these debt consolidation companies. Again, because a Chapter 13 bankruptcy, not to go too far into that is debt consolidation, but it's administered through a court system. And that is not, people get afraid of bankruptcy, and I'm not encouraging that. It's a way to solve a debt problem, not a credit problem. Sometimes you have to hit that reset button, but it's not as cut and dry that says, hey, if you're at 510 or lower, you need bankruptcy, versus if you're at 540, yeah, we can work through it. It's a matter of, can you manage the amount of obligations and keep your head above water? So it's a debt issue, not a credit issue.
Yeah, and I find myself in the same, part of that answer is like, we're not really here to give bankruptcy advice. Obviously I think we got to reserve that for a lawyer. When you go talk to him, as him or her, is this the right decision for me to do that? There's, and rebuild credit. Okay. So, and then if not, how should, okay. So if they don't file bankruptcy, and I've got an answer to this, Jim, and if you don't, I'll take it, that's fine. But if they don't file bankruptcy and we don't use one of those debt consolidation services, which I have also seen very disreputable companies and probably a lot worse credit carnage because of some of these entities, is there a recommendation that you would make on how they would manage it? If not, I can take the rest of that.
Yeah, well, I'll give a short answer, and then you may dive a little deeper. But the short answer is, at that point, it's a case-by-case situation. You need someone like Rich to look at it first, or me to look at it, certainly, just to see what's going on and where you're at, what means of righting the ship are available. There's not a standard answer that says this is what you do, because it can be a case-by-case situation.
Yeah, I think that's fair. I think if you decide to take it on yourself, and the assumption is that for whatever reason you're going to take it on yourself, and again, that's really not my decision to make, but let's say you're going to do it, whether it's a character thing, you just can't file the bankruptcy, or you think it's going to be manageable within a reasonable amount of time to get yourself reset. Like we talk about this in the wealth building class, as far as getting rid of credit cards, is you take whatever these debts are, they're all not getting paid, so we'll just take the smallest debt and then tackle that first. Then we'll move on to the next smallest debt and the next smallest. So we're going to take the smallest. So if you had $200, $500, and $1,000, we're going to ignore the other two. We're going to get rid of the $200 first. Then we're going to work on the other ones. And then as far as rebuilding credit after you get rid of that stuff, and that'll be the final part of that question. How would somebody go about rebuilding credit? And that'll be a nice segue into Frank's question.
Yeah, so it's, and keep in mind, again, debt is debt, credit is credit. So the older that things get, sometimes, I mean, here, debt, if you don't pay your debt, it's owed forever, right? Whether, even if it falls off your credit report, if you borrowed $5,000 and didn't pay it to a credit card company, it's still legally owed, regardless if it's on credit or not. How that gets handled down the line is, that's up to you at some points, and up to them and how their ability to collect that debt too. But when it comes to how all that impacts credit, sometimes older debts aren't as relevant to what you're going to do in the future. And so when it comes to building credit, right, there's starting points for that. Sometimes it's a secured card. Sometimes it's an authorized user account. And by the way, when I say authorized user accounts, do not pay to get added as an authorized user through one of these rent a trade line companies. It's fraud. And we can talk a little bit more about that if anybody has questions about that, but it's deception as far as the Federal Trade Commission is concerned. So, but there's legitimate ways of being added to a family member's authorized user account, doing secured cards. The point is if you are building credit and you have issues in the past, you need to start doing it yesterday, because you want to get that history going. It doesn't change on a dime as soon as you do it. They're looking for clues. You got to start giving them those good clues. Work on the bad, work on the good at the same time.
Yeah, secured credit cards are a really good way to do that. Most banks provide some sort of secured credit card. You give them $300, they give you a $300 credit limit. There's your secured credit card. So,
and by the way, Rich, if anybody here on the call wants me to send them the link that we send to all of our clients for establishing credit and for the secured cards, we've researched them all and we have some really good ones. So I'd be more than happy to share that with people if they want.
Yeah, if you want to put it in the chat, I think, if you want to put it in the chat, that's perfect. So yeah, and then I'll talk about, about the, relative to being added to authorized user accounts. Yeah, your relatives, you want to be added to those accounts because you're going to get credit for that stuff. Mm-hmm. So Frank asks, what is the best way to establish credit for a teenager, which is kind of funny because we've talked about that in other presentations.
Yeah. So remember my daughter's credit report that we had there? I have two daughters, that one, and then a younger one. I had them on 4 of my credit cards since they were 12 and 14, something like that. That was her credit score was 844 when she was 19, right? Both of them had over 800 scores when they were 18 years on their birthday. I always, on their 18th birthday, I'm opening up the computer to pull their credit reports, and they're like, "What are you doing?" And so, but yeah, adding children or teenagers to authorized user accounts start building their credit right away. The reason why, by the way, the interesting thing, why those two scores for my daughter were so different. The 844 score, remember, different models have different algorithms. They have different ways that they calculate things. The FICO score 8 acknowledges, the FICO 4 acknowledges authorized user accounts. The other one did not. So the 668 score, basically, it can see those 4 credit cards that were very healthy, long credit, open for 30 years, great credit cards. They are on the credit report, but they bypass it in that algorithm and created a 668. The other scoring model acknowledges the authorized user accounts, and that's what gave her an 844. So that's a perfect example of seeing how different algorithms treat things differently. But the short answer is add your kids to your authorized user accounts for sure.
Yeah, that's great. So your kids have credit cards that are older than they are, which is hilarious.
Yeah, so, actually on my daughter's 18th birthday, it said that her oldest credit card has been open for 32 years.
That's perfect. Again, that's some planning.
Yeah, it's total planning. Yeah. you know, so there's not a there's only the logic is only as good as they programmed it to be. So sometimes there's some things that just don't make sense. So
There you go. Hey, Jim, on that, are you able to put that link into the chat, or is that something we'll have to send to people later?
yeah, we're gonna have to send that later because for me to kind of dive into, I got to get the link.
Okay, yeah, no problem. So for
I'll
all the attendees here, we will definitely get that link for you with regards to great places to go for secured credit cards. So
and I'll send you
with,
the link for my where I pull my credit from too, and where we
okay,
advertise.
that's awesome. Yeah, you get that to Tony. Tony will have the list of everybody through there, and she'll send it. She just made a note that she'll get it sent through the feedback email. So perfect. With that, let's go cover our pies so we know what goes on and how these credit scores are formed.
Yeah. So to no big surprise, the biggest category is past delinquencies, right? But it's actually only 35% of the score. What most people typically, again, without proper education about credit, they usually assume that bad stuff, late payments, collections, charge off, all the bad stuff is like 70, 80%, and the rest of it's inquiries. And past delinquencies is only 35% of your score. So it's the biggest component, but they basically, remember, they're trying to predict from today's date, what are you going to do in the next 24 months? So how recent something has happened, that is really, really important, because if you have a 30-day late payment that happened 60 days ago, that looks like, hey, the wheels are loose right now, right? To a scoring model, they think, okay, that just happened, it could happen again. But if you have a late payment from 4 years ago, at a certain point, it almost is starting to be almost meaningless to your scores, because it just doesn't mean that if it happened that long ago, that it's going to happen again. So they do look at how recent, how severe. Was it a 30-day late payment, or do you have a charge off with Amex for $5,000? You know, there's the severity is a big deal, and how often it's happening. Is it one time slip up, or is it you know, is it a habit of that you got late payments all over the place? So they're, you know, again, they're just trying to figure you out. So here's the biggest category that everybody can control to some degree, and the place that you can typically improve your credit is quicker than any other category, and it's your debt ratios. And remember, this is not debt to income. Income is something Rich talks to you about on the application. This is just debt ratios. This happens to be 30% of your score. Okay, so here, keep in mind, this is 30% of your score. Delinquencies are 35% of your score. This is almost as important as going late on your obligations. Okay, now this is, it does have to do with car loans and things too, but the lion's share of it is your credit cards. And the short answer is, what are your balances in relation to your credit limits? How much are you using? You have $1,000 credit limit that they gave you to use. How much are you using? Now, the reason why it's so important is, in all the studies through FICO, remember, they're math people, they're trying to figure things out. And what's the first thing typically that happens before you go late on a credit card, right? You kind of max it out, right? You kind of keep the wheels on, keep charging, you know, pay it down, spend it, pay it down, spend it, until you can't do it anymore, right? And then, so it's extremely predictive of a future delinquency the closer you get to your credit limit. Now, they do not use the dollar amount. That is really, really important. They use the percentage. And what I mean by that is, this is where people that are rebuilding credit, like we were just talking about, getting a secured card, people that get a secured card and get a $200 or $300 limit, if they go out and charge $150 on a $300 card, they have possibly dropped their credit scores. Even if they pay it on time, they possibly have dropped their scores because they have used 50% of that credit limit. That's really no different than charging $5,000 on a $10,000 credit line, credit card. So it's always the percentage, and that's really, really important. They do card by card calculations, but the bigger and more relevant, without going too deep down this, you want to look at the aggregate, the whole. That means add up all of your cards together, add up all the balances, and add up all the limits. Do that calculation. That's the more relevant calculation to the scoring model. They will do card by card, but aggregate is the more important number. Now, this is I always love this topic of what's the percentage, because everybody says keep it under 30%, keep it at 29%, right? And it's not a bad answer. It's just not the best answer. And the reason why people hear this is, first of all, it's all over Google. Most credit repair companies say the same exact answer, but I can promise you, it's even in FICO's blog, keep it just under 30%. So there's a lot of misleading information about that, right? So why would anybody think different? I think that people gravitated to the 30%, keep your balance at 30% because it's 30% of your credit score. It's nice and easy. I can promise you, you will not maximize your scores in this category, keeping your balances at 29 or 30%. You need to keep it at about a nice low single digit. We tell people 5 to 10%. It's just a better number. Now here, keep in mind, if you're at 100% of your credit limit, getting down to 50 is better than being at 100. Being at 30 is better than 50. But you don't want to stop at 30. You really want to be down as low as possible, but a greater number than 0. Remember, the scoring models are trying to figure you out. So they need to see you using your credit cards without abusing your credit cards. They just don't give you that instruction manual on how to maximize your scores when they hand you a credit card. They want you to spend money. They want you to pay interest. That's how they're making money. They have no obligation to teach you how to play the game, but that's what you need to do. And people with these smaller limit cards, first of all, you want to get the highest credit limit you can. If they will offer you a $20,000 limit tomorrow, which for some people that might be available, other people they have to build up to something like that. But if they'll give you 5,000, 10,000, 20,000, take it. I mean, I have a card I think is 30,000. I don't even use it. I use it once a year, and I buy lunch with it just to keep it active. They want to give big credit lines, but they're managing risk too. Now, there's a couple of reasons why people typically won't take those big credit lines. It's because the fear of, well, if I got a $10,000 credit card, if somebody steals it and they charge it all the way up, I'm on the hook for it because I don't subscribe to LifeLock, which, by the way, LifeLock you don't need LifeLock for something like that. Under federal law, every consumer is protected to a maximum of $50 of fraudulent credit card charges. Do not worry about it. The other reason why people don't take a big credit line on a credit card is they can't sometimes trust themselves, right? And I get that. But the point is, you need to show these scoring models good, positive clues. Somebody gave you 10 grand and you're not abusing it. And the best way not to abuse something like that is put the card in your drawer. If it's not in your pocket, you can't use it. So that's what I do. I have 5 cards, 4 of them are in my safe. I carry 1 and that's it. So you want to keep it at a nice low percentage.
And Jim, let me jump in here for a second on for a couple of reasons. Number one, so again, just to kind of be really simplify it, $1,000 credit limit from your credit card company, $950 balance, that's going to create a situation where you're maxed out. It's hurting your score. Conversely, that 30% number that Google or that's out on the web, whatever, that's discussed would mean that your balance is around $300 on the $1,000 card. But Jim says even that might not be optimal. Optimal might be closer to $100 or less on that $1,000 card. Now, Frank has a question. Does it hurt to carry 0 balances? And I think it's an activity issue, but I'll let you go ahead and explain that.
It doesn't hurt. It's just, it's again, it's a difference between being at 20% and 15%. You're just not going to get, certainly being at 0 is better to being at a high percentage, right? But you're not going to maximize your points. And when I'm talking about, we're kind of splitting hairs a little bit, but if you're at 0 versus 2 or 3% of your credit limit, you might see at 2 or 3%, you might see 7 to 10 points more than if you're at 0. So, but again, nothing exists in a vacuum. There's a lot of, factors that go into the scores. But if you want to maximize that, here, if you Google CNBC perfect credit score, it's an entire article about how I manage my credit. And there's strategies to do those things the right way. It's one of those things, you can have really good credit scores having a 0 balance. You won't have a perfect 850 that's overkill anyway. But the short answer is small percentage. They want to see you using it, but not abusing it. If it's 0, for all they know, you know, maybe you're not using the card, right? Maybe you cut it up, maybe, you know, who knows? And so
Yeah,
you want to give them
yeah,
the right examples.
and you're not getting any credit for that because you're not using it. Now, one follow-up point to that, Frank, if you get the bill and it's whatever, it's $200 and you instantly pay it off, that's at least use. So you don't carry a balance necessarily, but you're paying it off in full every month. I think they would like that, especially if the balance is low to the limit. Correct, Jim?
Yeah, that's something that we're going to cover a little bit, called trended data, how much
Good.
you're paying on your credit cards.
Okay.
And
I
that's
want
different. Yeah.
No, that's perfect. And I want to get to Mike's question because it kind of follows up on this, and then that'll give us a good segue to get off this topic. As long as we covered everybody's questions. But Mike asked, do they look at credit card debt ratios in summary or individually? As an example, $30,000 capacity over 5 cards, but you only use one versus using all 5. I think you touched on a little bit
Yeah.
of that, but why don't you
Yeah.
answer Mike's question just to.
Sure, Mike. Yeah, it's the aggregate, it's the total, which is also why if you have smaller active cards and you got that one card that you just don't use, but it's a $15,000 credit limit, zero balance, it's just in your drawer, you just never use it, it's not part of your routine. That's why you don't close that one, because that is helping out your aggregate total in a big way. So yeah, it's the total, not necessarily card by card.
Yeah, and conversely, if he had $25,000 limit on one, and the other 4 were, let's say, a thousand, but if 2 of those 4 were maxed out, while the aggregate's low, the maxed out's probably not a good idea.
Yeah, right. And here's the other thing too. And when I say keep it at 5 to 10% or somewhere in that area, that doesn't mean every single card you have. Like if you have 6 cards, don't have a balance on every single card. You don't want to have a balance. You only want to have a balance on about 1/3 of your cards. Like I have 5 cards, I have a balance on 1 or maybe 2 once in a while. So because you just look like you're plastic happy. If you have a balance on if you have a $100 balance on every one of your cards. I mean, again, it's not terrible. It's just if you want to maximize your points, use a couple of your 4 cards or something. And by the way, it all comes down to, if you don't have any cards, you got to start doing that right away. And don't absorb too many too quick. Get 1 or 2. Let it sit for a while. If you get too much too fast, and this kind of comes up to this next category of average age of your file. You start accumulating too much too quick, your average age of your file starts plummeting, and this affects your credit scores negatively. People don't think about this. And history is the one thing that is very difficult to change, other than if you add an authorized user that has long history, because that will go on your credit report. But in general, absent of an authorized user account, length of history is just something that's you got to, you start sooner than later. And so that's why you don't want too much too quick.
Yeah. I'm going to give a quick answer to Tony. I didn't want her to think we were ignoring her question, and I'll let you jump into the slide. So the question is, what is a secured credit card? Secured credit card is when you go to the creditor and you give them the amount of money that they are going to give you in credit limit. When you have very, very low credit or poor credit or no credit, it's easier for somebody to extend you some credit if they've already got your money in their bank in case you default. So you give the creditor, whether it's a bank, a credit union, or some online company, you give them $300, they give you a $300 credit. That credit card is secured by the $300 you gave them that's probably not earning you any interest at all. So that essentially is a secured credit card. All right,
Yeah.
Jim, average age of the file. Let's jump in.
Yeah, so I'm gonna kind of say a couple quick things on this, because there's some other bigger things that we got to cover, and we're gonna run short of time here. But a couple things on credit cards: stay away from store cards, stick with the bank cards, Visas, MasterCards. That's the short answer. I always will tell you, always don't ever close a credit card, period. There's one exception to that. If you have a secured card, at some point you're going to want your $300 back. I get that. What you want to be sure to do is manage the account the right way, so that secured card that you're taking those steps to build credit, that you're doing it in a way that you actually have used it as a proper stepping stone to get those unsecured cards, and you are in a good, healthy position before you close it. So don't close it too early. But that's the one exception, closing credit cards, is when you got to get the secured money back. Okay. So mix of credit. Again, this is going to be a quick thing. You have to have a little mix of credit because they want to see how you're managing your credit cards versus your installment loans versus your mortgage. Of all these categories, credit cards is the most important for your scores because it gives them the most clues on how you're managing credit. And it's actually the easiest thing to start out with. So, but on the big picture, you want to have a mix of everything so they can see how you're managing all different types of debts.
And Jim, I wanted just one really quick point to that. I literally just looked at a credit report in the last 10 days where installment loans looked great all day. Not a credit card could be found, and that credit score was hovering around 700. Pays all their installment loans, got student loans, car loans, but no credit cards at all. Perfect credit. Credit's right at like 699, 700.
Yeah, they're probably
yeah.
they're probably missing 75 points or so just by not having a credit card. Something
It's
like
a big deal to have a credit card.
yeah.
Go ahead, Jim.
For sure. Okay, inquiries. We kind of touched on this. Hard and soft inquiries. Hard inquiries are the ones that count in credit scores, right? And these are the real easy way to think about this. Anyone who can lend you money is a hard inquiry, basically, right? If anything else is a soft inquiry. If you want to, and when we're done with this, you want to go online and pull your credit reports, any place you can find it, you can do it 10 times today, 10 times tomorrow. It never affects your credit. And remember, it all comes down to what's the purpose of a credit score? Predicting actions that you're going to take in the future, likelihood of a default. How can you impact your ability to pay your bills if you're just looking at your credit? It doesn't, right? So just that's the thought process. Always remember it's predicting future delinquency. So all the inquiries stay on a credit report for 24 months. That doesn't mean they're affecting scores. Only hard inquiries affect scores for 12 months. And soft inquiries never. Now we're gonna skip this because we covered that deduplication logic.
Yep.
So yeah, here, sorry. Yeah, that's the window. Okay, I'm not going to cover this. I just want you to see it because you're going to see and hear a lot about Vantage Score coming, because when you go to Credit Karma, Credit Sesame, most of the places that you're going to see your credit scores, they're going to be using a thing called a Vantage Score. And remember that this pie chart, this 30 on FICO on the left, 35, 30, 15, 10, 10. That's how they analyze your credit scores, how they calculate it. Look at Vantage Scores. It's different. So is it any wonder that your numbers are going to be different? The math is different. The algorithms are different. You don't need to know or memorize all this. I can send you a screenshot if you want. I just want you to be aware of there's a battle between FICO and Vantage Score that's going on. And by the way, the battle is FICO. Vantage Score is owned and operated by the 3 credit bureaus. They are coming after FICO hard. They want their market share back. So again, this is a screenshot, and I'm just trying to, I don't mean to wrap some of these up too quickly, but I want to get to some of those big changes that are happening right now. This is a screenshot. I'd be more than happy to send everybody. This just kind of tells you if your score is a 680 or if your score is a 780, what the impact to your score is if you have certain adverse events. If you have a 30-day late payment, how much your scores typically drop. It's just interesting information. If you have a 680, how much your scores drop if you have a bankruptcy, or if you're a 780. So again, just interesting information that, again, I'll send out to anybody if they want that. So okay, here's some of the changes. This has been going on for 3 years or so now. Judgments and tax liens were removed from credit reports. Okay, they still matter when you apply for a mortgage. They're still county records. Mortgage companies will still find them in a different way. So it's not a pass. What it is that the good side is it doesn't impact your actual FICO scores. You will not see judgments and tax liens on any credit report you can access because they're just not there anymore. So that was a win for the consumers for sure. This is trended data. real quick, this is what Rich, you were touching on a little bit. How much you pay on your credit cards matters. It's part of new scoring models, and meaning that if you just pay the minimum, that you're going to get rewarded more points on different models when they start changing models eventually. Start doing this now, right? Instead, if you got a $25 minimum payment, pay 100, pay 200, pay the whole thing off, whatever it is. It might not seem now that you're going to benefit from the scores, but you will when trended data or time series data is what they call it, when that starts becoming relevant in the scores. It's coming. It's sort of like take actions now, it will benefit you later. Okay. Scoring the invisibles, there's a lot of ways that they are trying to calculate people's credit scores. There's 3 ways that you can get a FICO score, by the way, just or 2 criteria really. You have to have one account be open for 6 months and one account reported within 6 months. If you do not have those things, you will not get a FICO score. Okay. And Vantage Score will give you a score. So they look for ways, they try all these different methods of scoring people. There's a Facebook score that they use to try to figure out how to score data. And so Experian Boost, I am personally not a fan of Experian Boost. If you want to, it's free. If you want to go in and give them all your checking account data, and the thing is, you might see your score improve on one model. It will not impact the mortgage scores when Rich pulls it. So the only time I suggest Experian Boost is if you have a really thin file and you don't have many trade lines, much credit on there, it can add a little extra accounts on there. But I wouldn't do that unless Rich advises it or if I advise it, because you're just kind of, you're expecting a score increase that's not really going to be relevant. Okay. We're ready for some of the big changes that just happened.
Is this the big reveal?
Okay.
Hold on. This the big reveal?
Yeah. So this is not the slide, by the way. This information is so relevant. It was yesterday. It was announced by the 3 credit bureaus. About 2 years ago, they announced that to help people with medical collections, they changed the reporting where from the day that you have a service, it cannot report to your credit bureau for 180 days, 6 months. The whole idea is, hey, give people a chance to work it out with their insurance, because there was a very aggressive debt collectors, a lot, that you go to the doctor and all of a sudden it's on your credit report 2 months later because they had the right to do that. So they stopped that. They said, okay, minimum of 6 months. But medical billing, that's the area 51 of the financial world, in my opinion. Nobody understands it. People just have things slipping by the cracks. You get a bill in the mail, you don't know if you're supposed to pay it or not pay it. Things end up on credit reports, and there's a lot of good people that have debts on their credit reports that are just adversely impacting them. I'm sure you see it all the time, Rich. And even if you pay a collection, it still impacts your scores negatively until yesterday. What happened yesterday is the bureaus announced, this is only for medical debt, is that now, first off, it's not 180 days. It won't report to your credit bureau for a year, 360 days. That's big in itself, right? Yeah, that's a big thing. You get time to work it out. The other thing is that if you pay off a medical collection, they are going to delete it from your credit report completely. That is a huge win. Now, granted, there's a lot of times you just don't want to pay it anyway because you don't feel you owe it. And in one respect, I think that that's sort of extortion, right? We're gonna harm your credit report unless you give us money. So I have some issues with that, but overall, it's a win for consumers. If you pay it, it's off your credit report. Here's the other big one, and this is equally huge, is that right now in the mortgage world of credit scoring, the dollar amount of a collection makes no impact to how it impacts your scores. Meaning that if you have $100 collection or you have a $10,000 collection, it has the same exact impact on a credit score for mortgages. Now, a $10,000 one might be a bigger red flag for an underwriter, but for scoring purposes, $100, 10,000, it's the same collection. But they are now going to they're not going to report any medical debt that has a balance of under $500 gone, which is,
Easy.
that's a huge one, because there's a lot of because when people get bills, they tend to freak out if it says $1,200. It's a bigger one, right? If something says $118, it's kind of like, let's see if they're not paying attention to it, and that's what crushes credit scores a lot for mortgages in particular. And so anything under $500 won't even appear whether it's paid or not. Any dollar amount that does end up getting paid, it's off your credit reports completely. Again, these are only medical. And then they're going to give you 1 year to kind of work it out with insurance.
That's huge, Jim. I mean, that's just huge. Is that effective immediately?
No, I think it's rolling out officially in July.
Okay. Yeah, I mean, that's so huge. So let me ask you this. In July, I got a lot of questions around this. And these medical collections definitely impact score.
Oh, yeah.
FHA is a little bit more gracious with it. They don't make us count the debt. That's not the world that we live in on Fannie Mae and Freddie, but FHA is like, it's medical. We don't really care.
But it still affects the score, though.
It still impacts the score, which is a big deal.
Right.
So my question to you, Jim, is like, do the paid medical bills prior to July, will they automatically fall off?
I would think so. I mean, I guess
Makes
I don't
sense.
know exactly the answer to that, but I mean,
Yeah.
if you take that day in July when they turn that switch, so to speak, whatever it is, if it's a zero balance, it's not accounts moving forward. It's just look at your report. If it's a zero balance, they're probably going to delete it.
That's awesome.
Yeah, it is.
Yeah.
It's going to be a game changer for quite a few
Yeah,
people.
that's huge. I wish July seems like it's going to seem like forever for clients I have, but it is what it is.
The reason why I think that they're doing that is there's a lot of different new models that come out. When it comes to FICO models, they come out with new models and new algorithms every few years, kind of like a Windows operating system, Windows XP, Windows Vista 7, 8, 10. And every few years they come out with a new model. The newer models that have been developed, like FICO 9, FICO 10, they actually treat medical bills differently. They know that nowadays medical bills are not an indicator or a great indicator that someone is likely to go late again. So they devalue those. The problem is in the mortgage industry, by law, they're still using the models that were developed in 1999. They're using Windows XP. They're using flip phones, basically. And it's not a lender's choice. They have to. So they can't go back and change the algorithm of those mortgage models. The algorithm is built. The only way that they can change it where medical bills don't impact the scores like they do for the newer models is just remove them. That's the only way. That's why I think they're doing it.
Yeah, that's awesome. That's great. That's great, exciting news. We've kind of come to the end, so to speak. We got everything covered, Jim. Perfect. I want to put everybody out there. We're a little bit after 10. We like to get these done in an hour. This was a huge announcement. I think it's going to go a long way. Anybody have any other questions, get them into the chat. We appreciate your questions, and you get one of these awesome. Hold on, I got to put it right in front of my bean right there. So yeah, you get one of those awesome mugs from us. Jim, Tony, if can you put how somebody would contact Jim in there, and then we will again follow up with an email that has a link to some of these things that we've discussed, such as a place to go out and get secured credit cards. And what else were you going to send them, Jim?
I am going to send where to obtain a credit monitoring.
Yep. Yeah, where to get a credit score. So we'll get those out to all of our attendees. We'll get that list from Zoom in probably about 20 minutes. So we'll get them out to you by Monday, no later than Monday at 5. You guys will get that. Doesn't look like I've got any other questions. I wanted to thank you guys all for attending. Jim's information is hitting there. Frank said also a list of things that impact your score. So maybe that screenshot of the pie, that they what percentage goes into the score. We could send them that too. We do have in April our next classes coming up. We do have for our real estate agents on the line, we're going to be talking about one-time close mortgages on April 12th. That's our virtual lunch and learn series. And then we will be talking about creating a personal budget. That's part of our customer wealth series. That's going to be on April 16th. And then we have our next home buying class, which will be April 23rd. So those are some upcoming classes for our customers, our real estate agent partners. We really appreciate you all. Tony's put some information in here with regards to the link. And let's see here, Frank want a list of how much each bad item affects score. Okay, good.
That one
And links.
screenshot, yeah.
Yeah, perfect. So we'll get that over to you guys. Thank you guys all for attending. Have a great weekend. Jim, you killed it once again. I mean, I'm very blessed to have you as one of our assets for our customers and our people and our employees and our realtor partners. So,
Yeah, and
Tony,
if anybody has questions for me or wants to, I put my email in there. I love sharing information. Just, call me and ask me any questions anytime.
perfect. And then Tony, couldn't do any of this stuff without you. Thank you very much for keeping me on point and keeping me organized. So guys, have a great weekend. God bless you all. Take care. Bye-bye.
Thank you.